All right, everyone. Welcome to a new semester. So this is International Financial Management. This class is typically taught to Masters of Finance and Financial Engineering students, but I was told to teach this class to accountants this year. So this is going to be a first-time experience for me. So again, the reason why I posted like a survey for you if you've been paying attention on Canvas was because I kind of want to know the kind of background you have coming into this class, because this is quite a applied course. So if you have strong foundations in macroeconomics, corporate finance, and derivatives, this is a very simple class. Okay, my job is basically to help you understand how to price foreign currencies. It's just another asset, and if you understand the law of one price, you understand corporate finance, it's all very straightforward. But as accountants, I really don't know what you're coming in with. So it may be take some time to adjust. You know, the terminology that I use may not be so familiar with you. So it's really up to you to let me know if something doesn't make any sense, and I'll go slower in my lectures. Okay. So this is International Financial Management. We will have class from 7 to 10, and we will have a basically 10, and we will have a 10-minute break somewhere in between. So maybe around 8:30, 8:45, I will take a 10-minute break. You probably need to use the bathroom. I need to use the bathroom, and most likely you'll have questions. So I'll have that time for you to come up to me and ask questions, or you take a break. All right, so all of our communications should take place on Canvas, and I'll repeat this again in the slides, which was written in the slides. Okay, you have two teaching assistants, Owen Wu and Xiaojie, who will be grading your exams and case studies. So I'll talk about deliverables in a few minutes. So in a nutshell, I already explained right earlier, this class is primarily understanding how foreign exchanges are priced. So how do you price foreign currencies? And how is that related to inflation? How is that related to interest rates? How is that related to the international monetary system, central banks specifically? So by the end of this course, you will understand how to price foreign currencies from an asset pricing perspective, and also how it's related to macro fluctuations, such as changes in supply and demand of output, for example, for a certain country. How fiscal policy, how monetary policy is related to foreign exchange rates. And by the end of that, you should be able to pick up a newspaper and read the Wall Street Journal and understand what they're talking about. Okay, that's kind of my objective here, so that you have the foundations, the framework to kind of read The Economist, the magazine, to read the Wall Street Journal, to read the Financial Times, and have a good understanding of what they're talking about. All right. So my slides are based on basically two textbooks. They're optional because I think I've distilled it down enough so that you can understand the course material without seeking outside material. So it's self-contained. That's my objective. Okay, I think I've consolidated my lecture so that it's self-contained. So long as you study the slides, study the past exams, you should be able to do well in this class. But if you need outside resources or practice problems, for example, I've listed those textbooks where I based my slides on. So that's Krugman's book, which is very, very critical for advanced undergraduate students or graduate students who's looking to teach macro to undergrads. This is the main textbook, and also International Financial Management textbook by Yoon and Resnick, which I think is renamed to International Finance now. So you may have seen other classes named International Finance, International Financial Markets, International Financial Management, International Finance and Banking. It's all the same. Okay, I'll tell you what international finance is really about in our lecture slides. All right, so our grade decomposition is two parts. 50% is going to be weighted on the final exam, and the other 50% is either in-class midterm or the case studies. So that's like, you can work in groups for the homework parts, the case study part. The midterm you take in class by yourself, of course. The final exam you take on your own. Okay, so I expect students to pass both parts. So whatever that passing grade turns out to be at the end of the semester, you should pass both parts in order to pass this class. All right, so I explained to you there'll be two case studies. There's going to be one case study. If you look at the timeline, so I'll briefly go over the timeline here, but basically there's going to be a case study that will be due week 5 or week 6. and there's going to be a case study that's due at the end of the semester. So that's like after our last class, I will assign the deadline after the last class. Okay? Yeah, so let me reiterate again for the case studies. You can work in groups. I don't care how large the group is. You decide how large the group should be. You should only submit one case study on Canvas to be graded. This saves our teaching assistants a lot of time. And I think it's helpful for you guys to talk to each other because you learn the most from collaborating with each other. All right? But I'm not going to regulate the group size. You decide who's in your group. Just make sure to write your group members' names on the case study that you submit, and only one person submits. All right? All right. I will also give you homework assignments that won't be graded. So this is the ungraded homework assignments here, practice problems. I call them practice problems. There will be 7 of them. I will go over all the solutions in class. All right? They're supposed to give you hints on what the exam, the midterm exam and final exam will look like, and hopefully give you a little bit more insight about the material that I talk about in class. Questions? Do you have any questions so far? All right. And in-class extra credit quizzes. So I found this to be quite helpful after the pandemic, when people kind of just have a very short attention span because lectures on Zoom I don't think is very effective. So I will give out likely a random quiz, maybe during our break. And it'll be like 2 to 3 multiple choice questions. It'll be physical hard copy. Okay? And you just fill it out, write your student name and your ID, and you submit it. So you can fill it out on behalf of your friend if you want. I don't care. I don't know what incentives there are because, yeah, it's extra credit. So you don't have to be here. So it doesn't impact. You can still get an A+ in this class, is what I'm saying. Okay, and it's up to my discretion how I use your performance on the quizzes. So I could augment your midterm grade. I could augment your final grade. I'll find some way to help you out at the end of the semester. Okay, that's the whole point of the extra credit quiz, to force you to follow the material, to keep up to date, and also to reward you if you do well on it through the quizzes. And it'll either help you in the midterm or the final exam. Great. All right. So let me give you a very broad summary of what I try to do in this class. First 2 weeks, I will give you an introduction and history to international finance and the international monetary system, which is basically, as I will try to explain to you, the source of the changes and fluctuations of foreign exchange rates. Okay. Week 2, I will start building a financial model. Okay, and I don't know how that's going to go given your background as accountants, but we'll see. So this is something that you should have seen in your other classes based on my understanding of the survey. But anyways, I will start from the ground up and just go really slow because it's quite fundamental. Week 3 to week 6 is exchange rate determination. So like I said, we'll build the model. We'll try to link it with very, very fundamental finance concepts, the law of one price, and how to reconcile the fact that exchange rates are used to price both commodities and financial assets, right? That's kind of the key, interesting part of foreign currencies. They're used to price convert not only the price of commodities, but also financial assets. So that takes a bit of explaining, okay? And that's what we're going to do from weeks 3 to week 6. Week 7 through 9, we're going to try to extend the financial model to incorporate the macro economy. Okay? The reason why we're doing this is because we want to understand how central bank actions, such as increasing, decreasing interest rates, changing money supply, how that impacts exchange rates, right? And also from the fiscal policy side, from the government's perspective, like issuing consumption vouchers in Hong Kong, how does that impact the Hong Kong dollar, right? That's one question you can ask yourself. All right. The last third of this class is risk management. So I think I asked you a survey question if you have risk management background. I think most of you, close to 80 or 90% of you, said you had. So it should just be all review. But if not, again, the course is self-contained. I will explain what each of those financial derivatives are, those contracts, and explain roughly how they're priced. Okay, and for most of you with the background, it might be slow, but for those of you who have no background, I hope it's good enough, at least for you guys. All right. Questions, comments on? Just make sure you guys know what you're getting yourself into. All right. Even though it's a required class for you, right? It's required. Yes. Okay. All right. So let me have no other questions. Let me go ahead and go to the slides. So today's objective is simply just to give you an idea of what international finance is. You hear it all the time. You see it in the textbooks. You see it talked about on the news all the time. So what I'm going to do is try to motivate exactly what international finance is and why you should care. And then start out by talking about the macroeconomy first. So as I already mentioned before, FX rates are used to convert prices of both commodity and financial assets. So there is a financial side and a so-called real side or macroeconomic side to it. And I'm going to start explaining the FX rates from the macro side first. So for those of you with macroeconomic background, this is just going to be all review. All right. And then I'm going to talk about what's called the current account. The current account, in a nutshell, can be seen in two ways, as you will see. But from the macro perspective, it's just simply exports minus imports. So it's just net exports. And I'm going to try to explain to you why net exports is related to FX rates, okay, in a big picture sense. You won't see it until perhaps 2 to 3 weeks later. And then lastly, in today's lecture, I'll talk about the history of international monetary systems. So just central banking around the world, how we went on the gold standard for a while, how we went off of it, how we went into a quasi-gold standard, and with one country was the gold standard and everybody else pegged their currency to one single currency and so forth. So I'll give you a brief history and why we are here today, okay, and not the gold standard or some other quasi-pegged standard. All right, so I already mentioned this, course logistics. I prefer communications through Canvas. So if you have questions about the course that you forgot to ask me during class or after class, just send me a message. And I will usually, if it's an interesting question, I will usually share it with the other students. Okay. I do have assigned office hours on Monday from 9 to 10. But if you want to talk to me any other time, you just message me. Okay, and we can schedule a separate meeting. Of course, you can also talk to TAs. You'll probably want to talk to them when you guys do your exam and see how they're graded. And of course, you have to make an appointment with them if you want to dispute certain grades. Textbooks are optional, serves mainly as a reference. All right. Ultimate objective of this class, how do you price foreign currencies? Secondary objectives, we want to explain how FX returns are related to the macroeconomy. So returns and rates are used interchangeably here. Okay, so that's just nomenclature, okay, just vocabulary. What is the role of central banks in FX returns? The reason why central banks have a role is because money is created from banks, from the central bank. Yes, we all agree. Central banks have a special power that no other banks have, and that's the ability to create money. And the question you should be asking yourselves first, before asking what international finance is what is money? Okay, and we'll talk about that. And lastly, how do you hedge against FX risks? Right. The last third of this class, we'll talk about risk management. We'll talk about forwards, futures, options, and a little bit about, lastly, a little bit about cryptocurrencies. So I'll talk about Bitcoin. Yeah, because it's on the CFA exam, so I feel obligated to talk about it. All right. Just reiterating again, 50-50 coursework final exam. I'll give you the details. Usually I have this course to be open book, and I think it's appropriate to be open book for you guys since you guys are master students. You guys are probably I don't know, doing internships or looking for jobs at the same time. So I don't want you to have to spend time studying. If you can organize yourself, your notes, organize your notes, right? Which is good enough. Okay, just be organized, and the exam should be very, very easy. Okay. All right. So usually, so I've taught different versions of this class. So when I teach undergraduates, I have to dilute the math a little bit, but for you guys, I'll try to keep it rigorous. And I always remind them, like, before you come to this class, you have to kind of make sure what you're getting yourself into. And the 3 core courses you have to have some exposure to, otherwise the vocabulary that I'm going to use may sound very, very foreign. Okay? So corporate finance is important because we're going to be pricing what's called currency swaps. And if you don't know what a bond is, you don't know how to do discounted free cash flow, then there may be a problem. Okay? But in any case, I will provide extra slides to go over very, very simple bond pricing if you've forgotten it. Okay? We'll get to that, the last third of this class. Macroeconomics, good to have exposure to what GDP means, how to break it down. And if you have some exposure to what's called the ISLM model, that's great. But if you don't worry. I will just teach it on the fly. Okay, it's not a difficult concept to understand. But if you understand what ISLM is, then it should be very fast to pick up what I'm going to talk about. And lastly, risk portfolio management. So, what is hedging, right? Do you know what hedging is? I don't know. In any case, I will talk about why we have these financial derivatives at hand and why some people may want to pinpoint exactly the kind of risk they want to be exposed to, right? So the example I want to talk about was like, I don't know, maybe several years ago, maybe you heard of Cathay Pacific made a very bad hedge against oil prices, airline oil prices, and they went the opposite way. They're supposed to hedge against the price to go up, meaning they're taking the opposite position, but they amplified their risk by taking the opposite direction. So if you're an airline and you want to hedge against price fluctuations of oil, that's what forward contracts and futures contracts are for. Okay, so that's basically what risk management is about, pinpointing precisely what kind of risk you want to be exposed to. In the example I give you with airlines, they don't want to be exposed to fluctuations in oil prices. You take a specific contract. The same thing for foreign exchange rates. If you're working for a company, you're an accountant, and you want to hedge yourself against fluctuations of currency value of the place you're generating revenue from, you would take a specific contract to hedge against that fluctuation, right? Okay. So I will use some calculus in this class. And in fact, I will derive everything even though there is some calculus. But you do not have to know calculus to do well in this class. Intuition is utmost important in this class, and the calculus and the math is just additional rigor if you want to know how things are derived. Okay, that's just for your own enrichment. So if you don't care about the math, that's fine. I will give you mathematical identities to memorize, and that's good enough to do well in this class. All right, so before I talk about today's lecture, let me give you a brief summary about me. My name is Shenjie Shea. I'm US born. I got my PhD at UCLA, and I worked at the Federal Reserve Board for 3 years before going to UCLA. And this is my first time teaching international financial management to master's students. So if you have suggestions for me, I'm going to be open to suggestions to modify the course. So it's according to your needs, okay? So please don't be afraid to say you don't understand something, or if there's a specific topic you want me to talk more about in the subsequent lecture, I can certainly do that. All right, so before we move on, any residual comments, questions about deliverables, expectations? Okay. If not, then let's start. So what is international finance? So the straightforward answer is it's the monetary relations between two or more countries. Okay, and that's a very kind of, something that doesn't really hard to understand if you don't know what monetary economics is all about. So monetary economics is really about changes in money supply, how that translates to changes in interest rates, and how that percolates into the real economy. That's what monetary economics is about. And what monetary relations is how we can have not only a single economy, but multiple economies interacting with each other. So we have different countries changing their money supply, increasing, decreasing interest rates, how that changes their output, how their output impacts our outputs, and so forth. So it's an entire network of countries now. And so we need to understand how interest rates are related with each other, how inflation rates are interrelated with each other, and ultimately how exchange rates are. So that's kind of where the key thing is we want to highlight here. Exchange rates is where all these things are interconnected. Okay, and you'll see this very soon in the next few weeks. Okay, so we will build a model that combines asset pricing theory, namely the law of one price, and try to link the law of one price with the macroeconomy. And I'll give you an example of what the law of one price is. That just basically says that if there is a discrepancy in prices for identical asset or homogeneous good across two markets or countries, you can make risk-free money, right? You buy low, sell high, and buy to cover, right? And then you get something for free, right? Something for nothing. That's what arbitrage is. So law of one price is arbitrage cannot exist. And I'll give you an example of this. All right, so before we talk about building up to that asset pricing model, I want to kind of just first pose the question to you. What is money? So I think most of you, I don't know, you guys are accountants, so I don't know if you actually took out your wallets. Well, in China, I guess you guys don't look at money anymore. Everything's digital. But in Hong Kong, yeah, we still use cash a lot. We buy, we pay our taxis and bills. Cash is also still quite prevalent in Japan and also in the US. And one way to get a sense of what money really is just to read what's written on it. So I give you a picture here of the 100 Hong Kong dollar bill. So maybe we read it together. So the first thing you can see is the Hong Kong and Shanghai Banking Corporation Limited. So it sounds like there is a bank that's issuing a specific asset, right? Some kind of security. It promises to pay the bearer on demand at its office here 100 Hong Kong dollars. So just based on the description here, right? We have a number here, $100. There's a promise by some institution, right? And it's issued by a financial institution. So right away, it should remind you of something like debt, right? Some kind of bond. And that's exactly how we should start thinking about money to begin with, right? So a good mental exercise is think about a bond that has some kind of interest rate, has maturity of, let's say, 1 year. And let's just decrease the maturity from 1 year to 6 months, to 3 months, to 1 month, to 1 day. So what is the real difference between a bond that expires 1 day versus just $1, right? Not much, right? You shouldn't. So when you take the limit of the maturity and decrease it all the way to 0, that's basically what money really is. It's a bond that expires instantaneously, right? And it pays out $100 today, or right now, instantaneously. So money really is just some form of credit, okay? So I'm going to emphasize that. Money is just some form of credit. And the only reason why you would accept money is because you can use this credit to redeem something, right? So another good exercise would be, imagine asking yourself, can I issue my own currency, right? Can I issue my own money? Most countries, it's illegal, okay? But if I could, what does it mean to accept Shenzhen dollars, right? What does it mean? It means that the person having that currency can redeem that money for something, yes? For something that I can provide. So that's exactly what money is. You hold on to Hong Kong dollars because you expect that you can use it to redeem for goods and services or some kind of financial return, right? That's how you should be thinking of what money is. It's a form of credit, right? When you accept it, you're basically giving somebody a loan, right? And you can redeem it by spending it on goods and services in Hong Kong, if it's Hong Kong dollars, on goods and services in US if it's US dollars, or goods and services in China if it's Chinese yuan, right? So that's what you should be thinking. Money is credit. Okay, so the more credit-worthy a country is, the more value of the currency, the more valuable things you can buy. All right. Comments, questions? All right, so as I said already, foreign currencies are special because foreign exchange rates are special because it's basically a conversion rate for two things: the real economy for real goods and services, but also financial assets, okay, if they're identical, right? Or, all financial assets, bonds, stocks, whatever, yes? And so there is a real side to it, and there's also a financial side to it. And I'm going to talk about the real side first before getting to giving you a preview of the financial side, okay? So let's take this for example. This is going to give you a good exercise of how we can price foreign currencies using homogeneous goods. Okay, so let me say that again. I'm going to show you how we can easily price homogeneous goods across countries using what's called the law of one price. Okay? So the idea is here. If you have two identical goods across two different countries, then they should be worth the same after currency conversion. Yes? If I buy a bottle of Coke in China, it should cost the same of a bottle of Coke in Hong Kong, assuming the formulas are different, they taste the same, they're bottled in the same plastic, blah, blah. Then they should be worth the same. Otherwise, I can buy cheap and sell high somewhere else, right? That's the idea. And if I keep doing this, the price should converge to a single price. Yes? So let's go ahead and do that. Let's assume the law of one price holds and there's no arbitrage. You can't make money out of nowhere. And we're just going to try to back out the price of a currency, in this case British pounds, in terms of Hong Kong dollars. So here in this picture, I give you an identical good across two countries. So in the UK, there's a supermarket chain called Tesco. You can find this chain in Hong Kong if you look hard enough, okay, if you're curious. So I have here a bottle of Coke Zero, 1.25 liters. And at the time of making this slide, it cost 1.45 pound sterling. Okay, so that's the L symbol is pound sterling, British pounds. That's on the left-hand side. On the right-hand side, we have the same bottle of Coke, right? Coke Zero, still Coke Zero. It's also 1.25 liters, but it's sold at Hong Kong dollars and 50 cents. Okay? Two different prices, quoted in two different currencies, obviously. Law of one price says after currency conversion, price should be the same, right? So let's go ahead and use that concept to back out the price of a certain currency, in this case, British pounds. So in this line here, this line here, all right, just do here. This line here, I start out with the price of one Coke in British pounds. So 1.45 pounds sterling per bottle of Coke, right? That's the price of one bottle of Coke. I'm going to multiply it by the conversion rate, E. So E is in terms of per unit of Hong Kong dollars. So for British pounds, we have E units of Hong Kong dollars. We want to back out the price of 1 pound sterling in terms of Hong Kong dollars, right? That's what we're trying to do. On the right-hand side, we have the price of Coke in terms of Hong Kong dollars, 11.50 Hong Kong dollars per one bottle of Coke. Yes? So solve for E. That's how we apply the law of one price. And we can easily back out the exchange rate. Yes? The exchange rate here, you can do the math yourself, should be 7.93. Yeah? So fairly easy and straightforward, right? But of course, this assumes that our entire economy is based on Coke, and there's no other good or service, right? So one thing you should realize, like, well, this E we're backing out is only applied to just one single homogeneous goods. Goods aren't necessarily homogeneous. You can obviously say that. And I'll give you ways to reconcile this much later in this class. But that's the key thing you should note. This is only what I'm doing now here as an exercise is I'm backing out the exchange rate just for one good. And our exchange rate is 7.93, right? All right, so we can easily do something else. Another more complicated good, but essentially identical. So in this case, we have a new car, a Jaguar. So Jaguar is a car manufactured or created in the United Kingdom. If you were to buy a Jaguar in the UK, it would cost you basically 40,000 pounds sterling. But if you buy it in Hong Kong, it's going to cost you, I think, significantly more if you think about it. If you look at the exchange rate now, it's going to cost you 638,000 Hong Kong dollars. So let's, again, go ahead and apply the law of one price to this identical good, right? Again, identical goods, law of one price says that arbitrage shouldn't yield any profits, right? You can't make something from nothing. And so we can go and do that. So here we have the price of one Jaguar in the UK for 40,265 British pounds, multiplied by the conversion. The price of one British pound in terms of Hong Kong dollars, that's what E is, equal to 638,000 Hong Kong dollars per Jaguar. Yes? Solve for E, we get an exchange rate of 15.84, right? Dramatically different from our 7, right? So what you should conclude here, well, there's something that's going on here, right, for this specific good. So does anyone want to propose some explanation why Jaguars are so much more expensive in Hong Kong as accounts? Maybe you have a tax perspective. Right? Yeah. Yes, exactly. So imagine, so tariffs has been a big thing since Donald Trump. So there's tariffs for literally everything now for China or between China and many countries. And Hong Kong probably has very, very high tariffs for importing cars. And that tariff will be most likely passed on to the consumer. So what the consumer pays is going to be dramatically different than the actual manufacturing cost of the car, specifically for Hong Kong. So not only tariffs, but you can also imagine labor laws, right? Labor laws in Hong Kong, there's nobody who's skilled enough to build a car here. But there's definitely more space and lower cost, right, in terms of rent and so forth to build the car. And that means less money is going to be, less cost is going to be passed on to the consumer, right? That can explain why the car is so much more expensive in Hong Kong. And another reason is competition, local competition. So if Jaguar has a monopoly or is very popular in Hong Kong, then they can definitely keep the prices elevated, right? Compared to, I don't know, the United States, which is very competitive when it comes to cars, or China, I don't know. But definitely, probably neither are very close to perfect competition, but probably the US is probably a little bit more competitive than China. Okay, so that's things to think about, right? These are economic explanations or economic frictions that distort what E should be. And we have many, many ways, macroeconomic ways to kind of address this issue, but it's important to think about it, okay? And to give you a little bit of insight into the future, what we're going to do, instead of looking at a single good, we're going to think about a basket of goods, right? That's kind of one way to reconcile these law of one price applying to many, many different goods and services. We should use a basket of goods and compare those baskets across countries rather than using a single good to back out E, right? Okay, so that's the real side. So we'll get to that very soon. All right. So the financial side of foreign exchange rates. So this is giving you a preview, okay? I'm not going to go into this today because it's not the macro side today. The intuition for why FX rates should be why the law of one price should also apply for risk-free assets, because we're only concerned about currency returns. So when I talk about returns, I'm not talking about holding onto the currency itself, okay? I only want to be exposed to the returns the currency yields and not actually bet on the fluctuations of its value. Okay? So based on the idea that if I'm only comparing returns on bank deposits, for example, across different countries. So bank deposits are virtually riskless, right? I put my money in. It's usually insured by the central bank. So it's basically risk-free if I put money in the bank and earn an interest, right? But every country, every developed country has something like that. And if I compare the rates across different countries, law of one price says the return should be the same after currency conversion, right? That's what the law of one price says. So let me say that again. Just like goods and services, interest rate returns on deposits is also applicable for the law of one price, right? And if that's true, then the returns on bank deposits in the US after currency conversion should be equal to the return you get in the bank deposits in the United Kingdom, or in Australia, or in New Zealand, or in Japan. Yes? Law of one price. That's all we're using, right? The fact we're not holding on to currency here, right? I'm just betting on the return. That's the key insight here. I'm only betting on the return, not the holding onto the currency itself. So how do you exploit what I just explained in a trading strategy, right? So what I just described to you is what's called a carry trade. So imagine there's a country, let's just say the US, has an interest rate of 0%, and another country, again, using as an example, the UK has an interest rate of 10%. If I just want to bet on the interest rate differentials, what I would do is I try to borrow at 0% and lend out or invest at 10%, right? But I'm not holding on to the currency. I'm not betting on currency changes in currency valuation. I'm just betting that the differentials will yield a positive return after currency conversion. But just based on that description, I kind of already gave away the problem with this trading strategy, right? If exchange rates change, then it could undermine this trading strategy, right? As I explained here, right? If I use the borrowed currency to buy a different currency, this will raise the price of the purchased currency. And so the borrowed currency will depreciate over time. So it's going to become more and more expensive to implement this trading strategy because the currency I want to invest or lend out in is getting more expensive. So my interest rate differentials that I make after currency conversions could be zeroed out. So don't think too much about it because I'll give you the math next week, okay? But that's just something to think about. So let me reiterate the key punchline here. The punchline is this. Just like the law of one price applied to commodities individually, homogeneous commodities, you can use the law of one price to also price bank deposit returns on currencies, right? Again, we're not betting on holding on to a currency. We're not doing any investments. We're just exploiting the interest rate differentials between two countries. The law of one price tells us that after currency conversion, bank deposit returns should be identical across all countries. Doesn't matter what given the same maturity. Okay, so fixed maturity, the returns should be identical after currency conversion. That's all we're saying. All right. All right. So I hope that intuition is solidified in your head. The key concept here is the law of one price. There's a real side to FX pricing. There's a financial side to FX pricing, and I will give you both ways to model it. Okay. And just to emphasize here, I will use different terminologies here than what you usually see in your corporate finance class or your, macro class. So when I say positive returns on an asset, the corresponding terminology for currency is appreciation. Okay, so if a currency gets stronger, that means the returns on holding onto this currency is increasing. Negative returns, that means the value of the currency is getting weaker over time. Okay? Negative returns, depreciation. They mean the same thing. I may use it interchangeably. Definitely they use these terms in the textbook. So just get familiar with the terminology for foreign currencies. All right, comments, questions? Okay. So my job today is to present to you a macroeconomic perspective on how to start thinking about FX rates and how that's related to international trade. And I think a good starting point is actually asking you to start thinking about countries as households, because I think that's the best way to think about it. So as a household, you do many things. You consume, you invest or save, you generate income perhaps from selling from your own businesses, and most importantly, you borrow, right? A lot of you, I don't know, may have thinking about buying houses, and your credit worthiness is an important factor in determining how much money you can get as a loan. And if you start thinking about countries as household, then it's kind of clear what is the foundation, the starting macro variable you should be thinking about. Okay, so a question I want to pose to you is, if you're looking to buy a home, what is probably the main variable a bank is looking at when deciding how much to give to you? That's right. So my proposal, and also the textbook proposal, is to start thinking about national income. Okay? That's our objective here. Start with national income, and we're going to proxy what the textbook and what most macroeconomists is they proxy national income with what's called GNP, okay? Gross national product. The reason why we do that is because GNP is easy to decompose. A more precise term is gross national income, but it's harder to calculate, all right, and harder to decompose. All right, so I kind of mentioned already, start thinking about income. Where does income come from? Well, you can look at what do people do with their income? Where does income come from? We can start thinking about these key economic variables, right? Unemployment. You need employment to generate income, and that determines your creditworthiness and the value of your currency, right? That's kind of the idea. Consumption. You make some income, you want to buy things, yes? That's also a determinant of your purchasing power or your income, yes? Disposable income. Trade and current account. Now, I want to emphasize here that you should start thinking about trade and FX rates as interrelated with a country's ability to borrow, not only in terms of financial terms like interest rates, but also in terms of real goods and services. Okay? And I'll explain to you very soon why that's the case. So the current account is a term you should all kind of zone in on. Okay? So the current account can be seen in two ways, basically two ways. It's a measure of net exports, as I kind of mentioned earlier, right? Total exports minus total imports. That's supposed to give you a measure of how much goods and services you're selling to other countries or buying from other countries. So if it's negative, you would have a negative current account, and you can think of it as you're over-consuming. You're consuming more than you're producing today, right? That's what a negative current account means. Okay, I'll talk more about this. But for today, I kind of want you to just emphasize here that just take for granted, it's a little bit oversimplification, but the current account for today, you should just think about exports minus imports in terms of just trade flows, commodity flows between countries. All right. Other key determinants of net income, GNP, and so forth is money supply, obviously, right? You changing money supply can change interest rates, and that's very important. Price level, so that's inflation, right? If you change money supply, you'll change inflation rates and so forth. And finally, exchange rates. Exchange rate, I will try to explain to you, is can be a tool to influence a macroeconomy, a national output, right? So A good example in the past several decades is mainly China. As you know, they must be in the news all the time. Weaker currency makes their goods and services cheaper, and that kind of drives export. Yes, and you'll see this very clearly in the model that I will present to you over the next few weeks. Okay, so far so good. So let me just go to the next slide. All right, so I kind of already explained this already. National income is our ideal measure that we want to pursue, but it's very, very hard to calculate and decompose. And that's why macroeconomists prefer to use GNP, right? Because it's easy to break it down to see, you'll see, break it down. And we will talk about what's called balance of payment accounting. So I know this is, so it means very different things, this kind of accounting than regular accounting, okay? This accounting just means we have a way to keep track of commodity flows and transfers of financial assets. Okay, so I'll talk about examples very soon. But the idea here is every transaction between nations is bilateral. If you buy something, you're importing something, but there's also a corresponding export, right? Your currency, right? So that's the idea. How do we keep track of these transactions? This is what balance of payment accounting means, okay? There's two so-called accounts just to keep track of certain flows. Current account tracks physical commodity flows, like goods and services. Financial account is purely financial assets, stocks, bonds, cash, so forth. Okay. Yeah. So reminder: this is nothing to do with real accounting. It's just a way for economists to keep track of trade flows, and a way to aggregate transactions at the national level. Okay. All right, so this equation is going to be our foundation equation we're going to be working with throughout the remainder, throughout this entire class. GNP, y equals c plus I plus g plus x minus im. Looks very, very familiar with GDP, right? You've probably seen that in your macro classes. But there's going to be differences, as I'll explain very soon. So y is GNP, c is private consumption, so that's households, corporations, so forth. I is private investments, again, corporations, households. G is government spending or government purchases, which is another form of consumption investments. Okay. EX is exports, and IM is imports. So I remind you again, whenever you see this, you should be thinking current account. So what's the difference between GDP and GNP? GDP is output of a country that's defined, that's aggregated by the boundaries of a nation. Okay, so Alaska, for the US is Alaska, you know, the mainland, right? California, Arizona, blah, 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 and you have Hawaii. If you're a foreign entity and you're producing things in the boundaries of the nation, that's counted in GDP. So if Huawei or Xiaomi has offices in California and they pay wages, those wages will count towards GDP. Okay, that's what GDP means. GNP excludes foreign income. Okay, that's the key difference. Because national credit, remember, we're focusing on credit worthiness of a country. We should only be focusing on national corporations, national households, and so forth that reside in the country and will live and consume goods and services in that country, because that's where credit worthiness is determined, right, at the national level. That's basically the gist of it. Okay, of course, there's going to be some minor discrepancies. So I'll talk about that right now, in case just to make it more clear. Okay. All right. So we have GDP. GNI, which is our ideal measure, but it's hard to calculate or break it down. And then we finally have GNP. Okay? And I want to split income into 4 types of categories. We have residents. Oh, sorry, foreigners inside. I'll just do that, it's easier. Residents outside. I'll just write residents out for simplicity. And foreigners out. The last one is kind of pointless, but anyways, just to be complete. All right, so for GDP. For GDP, it includes foreigners inside the country. So if you have friends working in Silicon Valley, their income counts as part of US GDP. Residents, US residents outside of the US, it is excluded. Foreigners outside, excluded. For GNI, include if spent in country. So GNI is very precise, in other words. So if you're a foreigner, you're coming to the US or to Hong Kong or whatever, and you're a tourist, you go and buy yourself a meal, that expense counts towards Hong Kong's or US's GNI. Residents out. Include if remitted back. So that means if I work in Hong Kong and I send my money back to the US, then it will count towards US's GNI. Foreigners outside, excluded. And lastly, GNP, which is what we'll be working with. Foreigners inside, exclude all. So it's kind of a coarse approximation, right? And for residents outside, include all. And for foreigners outside, exclude. You don't need it. So I'll remind you, I know some people are tempted to take pictures. There's a reason why I turned on Zoom here, because I'm recording the screen. And I have a microphone here because I'm recording the lecture. So after today's lecture, I'll combine the two and make it available to you. All right, so you can spare yourself the effort to take photos. All right. Comments? Any questions for the difference between GDP, GNI, GNP, and the intuition why we should think about net income as opposed to GDP, right? Which is what you've been familiar with in macro. So again, the intuition is we're thinking about the creditworthiness of a country. Creditworthiness is actually determined, should be only applicable to those that reside in the country. Corporations that are incorporated in the US, people that are living in the US or in whatever country you're in Hong Kong, whatever. Only people residing in the country should be a factor in a country's creditworthiness, right? Okay, so if you want to convert GNP to national income, there are some extra steps. You need to subtract out depreciation. I'm sure you all accountants know what that means, so it's a minus sign. Unilateral transfers, so that's like domestic helpers in Hong Kong sending back money to Philippines. That's a unilateral transfer. That needs to be net unilateral transpositive. So if there's money coming in, if the country we're talking about is Philippines, there's money being sent from Hong Kong to the Philippines, then it's going to be a plus. Yes, it's a minus for Hong Kong. And other types of unilateral transfers could include like foreign aid. So if China or the US donates money to tsunami in Japan or whatever in Thailand, Bangkok, that should also count towards national income. Okay. And lastly, tax wedge in prices. So this is just a fancy word for tariffs. Okay, there's going to be a difference between, most likely a difference between what is being paid by the consumer and the actual price of the actual commodity or good or service, right? And if the consumer pays more for its actual worth, then that difference needs to be subtracted out, right? Because if I import a car and the tariff is 20%, but I only get 80% of the value, that 20% should be taken out, right? Okay, so clear on how to, so I won't test, this is not going to be tested, but just for your own enrichment if you want to know the difference between GNP and GNI, okay? But it's important to know why our starting point is national income and the difference between GNP and GDP. So I'm going to give you an example, a toy example, to highlight this distinction. I forgot to clear this frame, so let me go through the example right now. So Robinson Crusoe is a novel about a person living on an island by himself. Okay, that's why it's called Robinson Crusoe. But in economics, we use this example to kind of as a representation of a closed economy. So we kind of want to know what happens when you open the economy to multiple countries, right? That's kind of why we're using this name. In any case, let's start an example here. Suppose we have one single source of means of production. Okay, so we're on an island, and the means of production are palm trees. So one palm tree, so palm trees are trees that produce coconuts. Okay, one palm tree produces one coconut, and then it dies. So I've defined you this single means of production. Okay, so Robinson Crusoe, the person living on this island, he has two choices. He can consume coconuts, or he can plant the coconut, and save for the next year. So it's delaying the production for next year. Okay, that's what the other option is. He can eat his coconut now or put it in the ground and get another coconut in the next year. So suppose you have this one person, let's go on island there, and he harvests 100 coconuts, but he borrows 10 from a neighbor that he needs to return sometime after he decides to harvest the next year. Okay? He plants all the coconuts and gets 110 coconuts, right, the next year. So my question to you is, what is GDP and what is GNP in terms of coconuts? Volunteers? So I'm going to call a name. Yeah, sure.
I think GDP is 110 and GNP is 100.
That's right. That's right. Excellent. All right, so let me explain, right? Well, how is GDP defined? In this case, GDP is defined by the boundaries of the island. So as long as any coconuts being produced within the island, that's how much GDP is. So in this case, 110, so GDP is 110. However, there's only one resident, and part of that coconuts that he produces has to be returned, right? And so that's someone else's income, right? That's not his income. That's somebody else's income. So 100 should therefore be GNP. Okay? So you kind of already got a sense, right, that there is a financial side to FX rates somehow, right? And I'll show you soon. So this is a very, very simplified example. There are, of course, famous, notable examples in real life where the difference between GDP and GNP are vast. And the example that's typically given is Ireland. You can check yourself. Just Google Ireland's GDP versus GNP. And you'll see that Ireland's GDP is 20% larger than its national income. Do you know why? Does anyone know why? Oh, you guys are tax. Yeah.
Yeah, because I heard that some big companies like Google and Apple opened its business in Ireland.
That's right.
And they did not recruit local.
That's right. Exactly. So it's a tax haven. It's a tax haven. It's a tax haven. Much of GDP produced by foreigners. So I guess there is, after all, some accounting in this course. So good. All right, comments, questions on this example to highlight the difference between GNP, GDP, why it's important to focus on national income, because you have many countries, not only Ireland, I'm sure there are other tax havens, that have this characteristics. And obviously, foreign income that's going to be moved out of the country eventually should not contribute to the creditworthiness of a country, which is what a currency is based off of, right? Your creditworthiness. Okay, so what I'm going to do now is talk about the current account. The current account, remind you again, I use the variable CA to designate it. And today, you should just be focusing on this. That is going to be defined in terms of commodity flows, exports minus imports, or just net exports for short. And I'm going to show you, give you some intuition of what it means. Okay? So the easiest way to kind of get an idea of what the current account is actually measuring is to kind of look at the GNP equation first, right? GNP equation gives us y equals C plus I plus G plus EX minus IM. And we can get EX minus IM by simply subtracting total income of a country, Y, minus all your domestic consumption and spending, right? So that's C plus I plus G. Remember, G is some form of spending too, right? It's like consumption vouchers from the government that you have to spend, okay? So it's some form of disposable expenditure, some form of this expenditure. So we take our total income from the economy and we subtract out C plus I plus G, and what's left is going to give you EX minus IM. So based on that formulation, that should give you an idea of what this means when it's positive or negative, right? It should. So that's why you should be thinking. What does it mean from this expression when CA is positive? So remember what I just said. Y is some measure of national income. We subtract all of our consumption, our expenditures, and if what we have left is positive, then what we have is savings. Yes? So a country with positive current account means that a country is saving or lending out to other countries. Right? That's kind of, things should start clicking in your head, right? Remember, right? C plus I plus G, that's domestic private spendings. after spendings, if I have something left over, it goes somewhere else, right? It must go somewhere else. In this case, you should think about CA capturing either savings abroad, like financial returns, or lending in terms of real goods and services. So the way to think about this is if a country decides to export to another country, what is that country actually accepting in return for exports? Yeah.
Well, I think they add capital, the capital count.
Yes, but more precisely, they get foreign currencies. Yes, yes. And accepting somebody's foreign currency is as if you're giving them a loan, right? Because you expect to use that foreign currency to buy goods and services sometime in the future, right? That's the key takeaway you should get from here. Okay, so let me say that again. From this equation, what I've showed you is just think about real goods and services for now. We're not thinking about financial stuff. Just think about commodity flows, goods and services. I buy cars, I buy oranges, I buy coffee beans, blah, blah, blah. Why is my total purchasing power, after subtracting my personal consumption, after subtracting my investments, after subtracting any sort of government benefits I get, if I have residual consumption power left, it has to go somewhere. And that's going to go into international trade, right? So you're producing things, and those things are moved out of the country. And when you move things out of the country, you're accepting something in return. And that's the credit or the currency of your trading partner, right? So a country with positive current account means that they are a net lender in terms of goods and services. Okay? So positive current account means you're producing more than you can consume, right? You have residual left over after you consume your goods and services. So you have a positive EX minus IM. And if you don't consume it, then you obviously exported it. And when you export something, you're trading it for foreign currencies. And when you trade it and you accept the currency, you are actually accepting their credit, right? You're accepting their promise that you can use their currency to buy something sometime in the future. All right, so that's the positive direction. Okay, so what if you have a negative current account? When you have a negative current account, it means that total output, which is Y, right, total income. When I say income and output, I mean the same thing, okay? Total, I use output because we're talking about real goods and services. So when Y is smaller than C plus I plus G, that means I'm actually consuming more than what I produce, right? So it's very clear, a crystal clear example would be the United States. They have been doing this for quite a long time. They're consuming more than what they produce, and as a result, they have to, rather than export, what do they do? Import, right? They have to import goods and services, and they export their dollars, right? Take my money. I'm good for it, right? That's basically what they're saying. So you have a negative current account. You're consuming more than what you produce, and that means you are a net. Not a net lender. What are you? A net borrower, right? You are a net borrower. So positive current account, you should think about it as net lender. When you have a negative current account, you should think of it as a net borrower. Okay. So that's the intuition. Okay. Remember, it's a little bit simplistic, I know. But from the real side, that's how you should think of it. Okay? All right, so the example I give you here, you have a positive current account means that Hong Kong residents give up domestic consumption or investments for exports. Yeah, so any excess goods and services that they make, they don't consume it themselves, so it's exported abroad. So in return, they get the promise of foreign debtors to pay back in the future. And that's going to be in the form of future net exports from somebody else. Or they get to import something, right? So they receive foreign assets for net exports. right? They give out exports, they receive foreign assets so that they can use that foreign assets to hopefully spend sometime in the future or get some financial gains, right? And you'll see where the financial gains part comes about very soon. So maybe I'll write to buy imports in the future. Okay. All right. Do you guys have any questions, comments, clarifications, terminology? All right, so let me give you some summary statistics, which is actually shouldn't be surprising to anybody, okay? So I know this is old data, but it more or less looks the same today, at least for the United States. I imagine last 10 years for China also the same. You should know they have had a positive current account for quite a while. US also similarly positive current account for quite a while, negative current account for a long time. All right, so this is the gross national product decomposed into its components. The y-axis is trillions, so let me highlight that, trillions of current US dollars. And I've broken it out into those, those three components plus current account, right? So blue line is consumption, green line is investments, pinkish red is government purchases, and the red tiny box at the end for each year is net exports, EX minus IM. And as I already said, right, US, this is US GNP. US has basically always been a net borrower or having a negative current account for quite a while. So in 2006, I believe they had a current account deficit of almost $900 billion. Today, they have about $950 billion. Okay? For China, surplus, they have a current account surplus of $400 billion today. I don't know about 10 years ago, but I imagine it's probably much higher magnitude than in the past. And Hong Kong has a surplus as well of $38 billion. So I don't know. These numbers don't really mean much without some context. But anyways, to give you an idea, what matters is the net difference. Is it positive or negative? So for US, it's been like this basically forever since 2001. Okay. If you want to look at these components in proportion to GDP, we can. The takeaway from this graph is actually this part, right? This part and this part. So you should notice, right, that as a percentage of GDP, US can consume beyond what they produce, right? It exceeds the 100% line. And they can only do this because they have a negative current account, right? They get to borrow, so they can consume more than what they make, basically. So exceeds production due to imports, right? This is they have good credit, right? And people are willing to take US dollars. All right. Anyways, just very, very high-level summary statistics of an economy. You can, if you want to enrich yourself, by all means, dig up data from China, dig up data from Hong Kong, dig up data from Singapore, Japan, so just to get an idea of what each country preferred current account target is. So that's something we'll talk about. So just remember, it's not necessarily bad or good to have a negative current account. Okay, it is a choice for each country to decide what that level should be. Okay, China thinks a positive current account is good because they want to grow their economy through exports. That's perfectly fine. Their target has always been GDP growth. US is different. They have a different mandate. They have price stability and employment. As long as those things are satisfied, they don't care what the current account is. Okay, But it's different for other countries. Singapore is different. Japan is different. South Africa is different. And if you're curious what their preference are, you should definitely, you can easily dig up their data and look up the breakdown of their GNP and so forth. Okay. All right. So before we go on a break, let me go over transactions. How do we track commodity flow transactions and financial transactions, and what's called the balance of payments? Okay. So as I mentioned already, macroeconomists tracks commodity flows using so-called two accounts. The current account, which is focused on debiting and crediting imports, exports. So exports is positive, exports is a credit, and imports is a debit. I'm sure you guys are all super familiar with those terms. Okay, financial account. So if it's not a commodity flow, then it's a financial transaction. So if you're importing, exporting stocks, bonds, any sort of financial security, it doesn't go in the current account. It only goes in what's called a financial account. So the key difference here is when we think about commodity flows, one account gets one of each account changes. Okay, that's kind of the distinction. But for financial accounts, financial transactions, the changes only take place in the financial account. And I'll give you examples. Okay. So double entry bookkeeping. Yeah, commodity flows are accompanied by reversal, as I said. And we use the debit credit terminology just like we do in accounting. Okay, so let's go through an example of how we actually track commodity flows and financial assets transactions. All right, so I'll give you two tables here. Let's go over the first table. The first table is a commodity flow transaction. So we have two countries. We have the United States and we have Japan. Japan wants to export movies to Japan. So as I already said, exports are credits. So we're taking the perspective of the United States. Exports are credits. Imports are debits. Because the US is exporting movie rights or licensing rights, whatever, it's going to show up as a positive amount on the current account. So remember, current account is commodities, meaning goods and services. So in this case, movie licenses, physical movies, DVDs, whatever, is going to show up in the current account. So it's positive here. And as I already said, every commodity flow transaction has a corresponding financial transaction. In this case, we are importing a financial asset because of our export, right? We're accepting, in this case, Japanese yen, so that we can export movies. So importing Japanese yen, because it's an import, it's going to be a debit, and it's going to be a debit in our financial account, right? So that's why it shows up as negative 10,000. So just based on this single transaction, if our current account is equal to 0 to begin with, after this transaction, what happens to our current account? Is it positive or negative? So if our starting point is CA equals 0, and then this transaction occurs for the United States, suppose we're talking from the perspective of the United States, is the current account going to be positive or negative for the US after this transaction between Japan? It's going to be positive, right? So there should be an increase in the current account, right? Or it's going to be positive if our starting point is 0. So from this bullet point here, if we have a positive current account, that means our exports exceeds our imports. Therefore, we are a net exporter. Therefore, a net foreign lender. The U.S., if it had a starting point of the current account being equal to 0, then it's going to become a net foreign lender. Okay, because we're lending them goods and services today so that we can use their Japanese yen to buy their goods and services some time in the future. All right. questions, comments on this export example? So I'll talk more about, I'll give you another example of goods and services transactions soon. But questions on this example? So I will write this just in case people forget. Import is equal to minus, which is a credit. Debit, sorry. And export is going to be equal to a positive. It's going to be credit. All right, second example. In the second table, purchase of Japanese bonds, government bonds. So still talking about the US, still talking about Japan. We're still taking the perspective as being US, the United States. And the US now wants to buy government bonds. So here, two things are happening, right? We're importing something, a financial asset, but we are also exporting something, right? We're exporting US dollars. So because these Japanese bonds are financial assets, all these transactions will show up in the financial account. So writing a check to buy Japanese bonds, US dollars, is going to be a credit on the foreign account. Sorry, the financial account. That's what we see here. And then we see a debit in the financial account because we are accepting literal debt, right? Literal debt as opposed to currency, right? So it's going to be a minus $10,000. So what you should know here is just based on this transaction, this shouldn't impact the current account, correct? You don't see the current account anywhere. So I've intentionally left out a key variable in the definition of current account because I think it might confuse people. The current account actually is supposed to also capture interest payments and dividend payments. Okay, so return on investments, in other words. Returns on investment should also be included in the current account as a positive. Okay, so if you're in this case, if the bond pays coupon payments, right, interest payments, that's ultimately going to show up on the current account. But I didn't show it here because it's a single transaction. But if the bond emits interest payments over time, that should be added to the current account. That's not an important detail. I won't test you on this, but that's just to be complete in my definition of the current account. So let me, I'll write it here, but just to remind you that I'm not going to ever use this anywhere else. Okay. Returns on investments. And then plus unilateral transfers, of course, right? Remember, balance of payments is bilateral transactions. So I'm actually omitting two things, right? But focusing on this is just enough, okay? So let me say that again. The last example on this page, purchase of Japanese bonds, is a purely financial transaction. You are exporting domestic currency, right? In this case, US dollars, and importing foreign financial assets. Okay? So just from that specific transaction, it has no impact on the current account. But over time, if the financial asset emits interest payments or dividend payments, like from a stock, right, that should actually change the current account over time. But I'm not going to test you on this in any way. This is just to be complete, just to be accurate in my definition of the current account. So remember, balance of payment is focused on bilateral transactions. So any unilateral transfers should also impact the current account. But I omitted that, okay, just to simplify our life a little bit. And also, you should add back returns on investments, right? So in this case, again, if the bond emits interest payments, you need to add it back to the current account. But anyways, this transaction itself, however, has no impact on the current account. Okay? All right. I hope I didn't confuse anyone with that last comment. But if do you have questions, comments? So you'll see why. You'll see why we have these two parts soon. Okay, after the break. Okay, I'll derive it for you. All right, so let's do 2 more examples, and then we'll take a break. In the top table, we have investment in Californian biotech shares. So suppose we have a startup company, and and this startup company is looking for investors. Okay, so you have, let's say you have a fund in Japan, and it wants to buy some of these biotech shares from California, and they want to import California biotech shares, so that's stock or private stock, and in exchange they will give the U.S. company money, right? Okay, so again, from the U.S. perspective, if we're exporting an asset, right, private shares or maybe publicly traded shares, maybe, it's going to be an export, and therefore it should show up as a credit on the financial account. Yes, because again, positive for export, minus for import. Yes. So they give the Japanese investor gives this biotech company money, and in exchange, we're going to export. The U.S. company will export shares, and in return, they will accept money, right? So there is a corresponding debit on the financial account. So they give us Japanese yen. We take that Japanese yen, we convert it to US dollars, and that's going to show up as a financial account. Yes, and we give them our shares, or the U.S. firm gives them their shares to Japanese investors. That's an export. It's a credit. Okay. So just based on this transaction alone, reiterate again, no change in the current account, right? Because we're just talking about financial account. But if the shares pays dividends, it should impact the current account in the future. So no immediate change in CA, but if stock pays dividends, should be, in this case, it should be subtracted, right, from CA. Right, because we're not holding on to the financial assets. It's not a return. We owe dividends to investors. Right? So this is from the perspective of the U.S. So again, that might be confusing. So let me write it here from perspective of U.S. So here's from perspective U.S. This is also from perspective of U.S. Okay. All right, last example. We're back to commodities. Now, suppose this biotech company this U.S. biotech company wants to import equipment from Japan. So import is going to be it's an import of commodity goods. Therefore, it's going to show up on the current account. And because it's an import, it's going to be a debit. And that company is going to pay for those equipment with US dollars. So it's going to be an export of US dollars. And therefore, because money is a financial asset, it's going to show up in the financial account. And because it's an export, it's going to be a positive. Right? So asset export, financial account, it's going to be a credit. And because it's an import of commodity goods, it's going to be a debit of minus 10 million or 10,000, some amount of money. So this transaction will have an impact on the current account, right? It will actually decrease because we are consuming or purchasing something today in exchange for currency so that they can use that currency to buy goods and services sometime in the future. So if the US started out with a balanced current account, that is CA equals 0, after this transaction, they would be a net borrower, okay, in terms of real goods and services. Yes? Okay, so let's take a 10-minute break. And if you have questions, you're going to come ask me. And we'll start around 8:40. Okay? So what I want to do now is show you the financial side of the current account. So what have you seen before? Remember, we defined the current account as net exports minus imports. But now I want to show you that the current account can be expressed in terms of two other variables, savings minus domestic investments. So if total savings includes domestic savings and foreign savings, or savings abroad, then S minus I should give you net savings abroad, right? And I want to show you basically that current account can also be expressed as S minus I. Okay? So this is what's called the financial side of the current account. So this should be quite intuitive, right? It's already intuitive in terms of real goods and services. Then the mirror image of that in terms of finance should also be identical, right? So our starting point would be like, so maybe I had that slide here. So starting point would be, think about a closed economy, right? In a closed economy, you're not allowed to interact with any other foreign country. And so any savings that a country has within itself is its investments, right? So S minus I. But once a country opens up to the rest of the world and conducts international trade, this should be some extra component, right? Total savings can potentially exceed or be smaller than I, and that's going to be captured by the current account. Their ability to borrow and lend between other countries, not only in terms of commodity flows, goods and services, but also in terms of finance. And we will see that this is actually the two sides of the same coin, all right? Yes. So maybe let's just go ahead and derive that expression for you. So my objective here is to show you this. Okay? I want to prove this. And then we'll go back to this slide in a bit. So let's go ahead and prove it. So our objective here is we want to show that S equals I plus CA. So in other words, total savings is equal to domestic investments plus the current account. And remember, the current account, you think about it as net borrowing, lending. Yeah? Also in a financial sense now. So we can do that. So let's decompose savings into two parts: private savings and public savings. So public savings is government savings, and private savings is, household investments. So I'm going to use underscore P to denote private savings. Private savings can be expressed using the variables you saw in the GNP equation, right? Total income or total output, same thing, right? Minus taxes that you pay, right, to the government, minus private expenditure, consumption. Another component of savings is government savings, and that's just tax collected minus government spending, right? Total revenue, total tax revenue minus the money they use to spend on their citizens, right? So that's T minus G, right? These variables you should all see before in the previous slide. Y is national income, or proxy for national income. T is total taxes that a household has to pay in aggregate, minus consumption. Anything that's left over is investments, right, or savings. For the government perspective, tax revenue they collect from their citizens. Anything that they don't spend is held by the government, right? That's government savings. So based on these two definitions of private and public or government savings, total savings, therefore, is SP plus SG, right? Sorry, SG, yes. And let's go ahead and just substitute those expressions in. And then realize that the t's cancel out, right? And also we can substitute the y with the full GMP equation. C plus I plus G plus EX minus IM minus C minus G. Correct? T's go away. You still have minus C minus G, and we simply just plugged in the GMP equation, right, for y. So we notice that the C's cancel out, right? The G's cancel out. So all we're left is I plus EX minus IM. Or in other words, I plus CA. Done. So as you can see, not only can we interpret the current account in terms of commodity flows, physical goods and actual services between counterparties, current account is also an expression of net savings abroad. Yes, because I's invest savings domestic, right? Domestic savings. Any residual from domestic investments is savings abroad. And if current account is positive, that means you have money lent to other countries. So if you buy shares in the S&P 500 from Hong Kong, you're basically giving US a loan. Yeah? Because you're putting your savings in US corporations. Yes. All right. So whatever I just showed you here is exactly what I wrote here. It's the same thing. I just walked you through it just to make sure everybody was on the same page. But whatever is shown here is exactly what I just walked you through. Okay. So the point, of course, is to highlight the financial side, right? It's not just lending and borrowing in terms of goods and services, which I tried to highlight to you in the past hour. But you can also think of it in the financial sense now, right? It literally is lending financially to other countries if you have a positive current account. A negative means you're borrowing from other countries. So given that interpretation, it should be clear, right? It should be pretty clear that you don't want a current account that's too extreme, right? You don't want an overly positive current account because that means you're lending potentially to a lot of people that are not good for the money, right? Bad credit. It's like Chinese investments in African countries. They're not going to get their money back. It's purely political for sure, most of it. Additionally, on the other extreme, you don't want an extremely negative current account. Very negative current account means that you have potentially very, very bad credit. Because a negative current account means that you have to grow your economy enough to pay back your lenders, right? And if you have a very, very negative current account, I don't think anybody would believe that you can grow enough to pay off your lenders, right? So the extremes is quite obvious, right? There's some middle ground that you want to potentially target your current account, right, for countries. It can be a little bit negative, fine. It can be a little positive, fine, but you don't want the extremes, right, based on these equations you see already. Okay. All right, so before I give you a overview of the history of international trade / monetary relations, I want to give you a third perspective of the current account. And it's not really a perspective. It's more of a mathematical interpretation of the equation. So I want you to now potentially think of the current account in the following way. You can decompose it potentially into two parts. And I'll try to give you some intuition for now, but you'll see it again later. Okay. I want you to think about the current account in terms of trade volume plus relative value of goods / services. And that will require some additional abstract thinking, okay? So in order to do that, I need to introduce to you a new variable called Q. And Q is going to be called the real exchange rate. Okay, and I'll tell you why it's called the real exchange rate. The reason why it's called the real exchange rate is because Q is defined as EP star over P. So let me tell you what those mean. So E is going to be our variable that we're going to designate exchange rate in this class. Okay, I'll talk about it next week, to formally talk about it next week. P star, I'm going to use the asterisk in this class to indicate variables of the foreign country. Okay, so when I say P star or CA star, I'm meaning a foreign country, okay, with respect to the exchange rate. So if my exchange rate is defined as Hong Kong dollars per US dollars, then P star is going to be the price level of the United States. Okay, so if we're talking, so if E is the price of US dollars in terms of Chinese RMB, then P star is going to refer to the United States. P without the asterisk, I'm going to use to refer to domestic price levels. So the question you should be asking me is, what do you mean by price level? So in macroeconomic terms, I'm talking about CPI. So maybe you know what consumer price index is. If not, what it is basically a weighted average of prices within an average consumption basket of a country. So imagine you aggregate everybody, all individuals within a country, their expenditures in terms of rent, oranges, groceries, utilities, cars, gasoline, blah, 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 all that stuff, and you weight the prices based on the intensity of the consumption levels. Okay, that's what CPI is really doing. Okay, and P, capital P star, and P refers to the price levels of the foreign and the domestic countries' average price levels. So it's called the real exchange rate because we're multiplying the exchange rate E by a price ratio, P star and P. So it's unitless, right? It's not in terms of currency units, right? It's just a unitless measure. It's important to introduce to you this variable here because it's kind of a motivator to show you the direction in which Q can change and how that ultimately influences the direction of the current account variable. So the reason we're defining the current account into these two components is because we want to understand how the current account changes when Q changes. Okay, that's ultimately what we want to do. How does the current account change when the relative price levels between countries change? Okay, so let me say that again. We want to understand, so why are we doing this? We're doing this because ultimately we want to know how CA changes when Q changes. And you can almost see this in the equation I've shown you today. But there's one extra step we need to do is just to convert imports this variable here into this equation here. And it should be pretty intuitive, okay? Think of CPI as just like a price of any goods or service, right? Stock is price per unit of stock, right? That's what the price of a stock means. Price of a bottle is price per unit of bottle. Then P star is price per unit of consumption basket. Yeah? So in that sense, then you can convert consumption baskets from one currency to the other, right, using Q. Agree? So the intuition is the following. Think of P star and P as per unit of a consumption basket. Okay? Then it should all go through, right? Then imports is simply foreign exports, but now in terms of domestic currency. So you multiply Q times EX star, that equals IM. That's it. Okay? If you don't get it now, that's fine. I will give you a formal definition, more math later on, but that's the way we move from IM to Q times EX star. So let me start over again. All right. I'm introducing to you this Q because we want to understand how changes between relative prices between countries impacts the current account, because that's kind of the main driver of commodity trade flows. If certain goods or service becomes cheaper elsewhere, you want to import that good and stop consuming goods domestically, right? If foreign goods become more expensive, you want to curtail your consumption abroad and consume goods domestically. So price levels here are the main drivers, should be one of the main drivers of the current account, changes in the current account. And we can see this change already by looking at how this current account changes with respect to Q by looking at the equation I introduced to you earlier, right? EX minus IM. And all we're doing is replacing imports with Q times EX star. That should make sense because all we're doing is looking at, it should be tautological. It should be identical, right? Because we're looking at foreign export, which is our imports, but just changing the currency value to our currency, and that's what Q does, right? So everything is in domestic currency or real goods and services in terms of our real domestic goods and services. All right. So let me be clear. P star here is foreign price, foreign CPI. I'm going to write CPI. So just remember it means write it here, consumer price index. And P equals domestic price, domestic CPI. And E, I will always define, and I'll reiterate this next week, it's not important today, as domestic per 1 unit per foreign, okay, for 1 unit of foreign currency. Okay? An example would be HKD divided by USD. Okay? So given this Q, we can use this Q to replace IM with Q times EX star. And the way to think about this is we're converting the value. We're saying that the value of foreign exports, which is our imports, into domestic currency levels. That's all we're doing. And based on this new equation here, you can already see where the trade volume effect and the relative goods value comes from, right? The trade volume effect comes from just EX. Why? Well, if Q increases, right? When Q increases, that means foreign goods and services are getting more expensive. You will most likely curtail from importing from your foreign trading partner and start most likely export your goods and services, right? Because your goods and services are cheaper than before, relatively speaking. So if Q star increases, our goods and services are more competitive, and that's most likely going to drive exports. That's the EX part, all else equal, assuming everything else is constant. Yes? The value part, the relative value part, comes from Q. So assume that there's no trade volume effect whatsoever. So EX and EX star are held constant. Then if relative prices increases in terms of Q increasing, then the current account is going to decrease, right? Because P star is increasing, Q is increasing, and the minus sign is going to be more negative, and the current account decreases. That's what's called the relative value of goods effect. It's not important now, but it's important to kind of keep this in the back of your head for now. Okay, so it's not an interpretation of the account. It's just a way to think about what changes what in the current account equation. So I'll write it here, what I just said. Increase in Q means foreign goods more expensive. Then EX increases. You agree? So that's what's called the trade volume effect. So the fact that goods and services abroad become more expensive relative to our goods and services, our trading partner most likely will import from us more, right? So there's more export from our perspective. So EX will increase. However, if we hold EX and IM constant, or EX star constant, then actually increase in Q will decrease CA. So this is EX and CA implicitly, right? All else equal. So everything I say is all else equal, meaning we hold everything else constant. So this here is the trade volume effect, and this part is the relative value effect. So what's the intuition here? Right? Why am I talking about this? Okay, it's important because we need to understand the dynamics. And in macro, we always talk about differences between long run and short run. So we'll get into that. So it's important to kind of know this beforehand before we dive into the macro analysis. But the intuition for trade volume should be straightforward, right? And we'll see this. You'll see this again when we talk about the gold standard. Okay. So prices are going to be driving everything here, right? If goods and services abroad becomes cheaper, we will import, right, rather than export. That's going to decrease current account. Foreign goods becomes more expensive, we're most likely going to export than import. The relative value effect, assuming no trade flows, if Q increases, then it's as if we're saying that the goods and services abroad are becoming more valuable, right? Because prices are increasing, but trade flows didn't change. Their goods and services are more valuable than ours. That's what it's saying. Okay? There's competing effects, is what you should be noting. So it depends on what you assume about EX and EX star. If in the very short run analysis, like a few months, right, if you have some sort of shock to P, but EX and EX star doesn't move, you could see your current account become negative, right, in the short run. But as trade starts to move, then the current account can turn positive. So that's something to think about, right? So it depends on your analysis. When you read the news and you see like, oh, the current account dipped a little bit, you want to know why? Well, here's the reason why. Because trade flows usually move really slowly. And it takes a few months for some sort of price shock to take place, right? Anyways, getting ahead of ourselves. But that's just something to put in your back of your head. And we'll get to it maybe in like week 6, okay? All right. Questions, comments? Does anyone have any questions? All right, so the last leg of today, I will give you some context why current account balance matters, okay? And in talking about this, I will talk about the history of central banking and around the world, and also exchange rates, basically. All right, so macroeconomic policy concerns. So hopefully you are convinced that foreign exchange rates are intimately related to central banking. Why? Because central banks are the sole entities that can create currencies as of today, right? It's illegal to create your own currencies in most countries. And in doing so, they can change the value of the currency in different ways, right? By most importantly, through changing money supply, increasing money supply, decreasing money supply. And we'll talk about that. If you don't know what money supply is, that's fine. I'll talk about it later. But it's just the quantity of currency circulating in the economy, right? So if there's more currency available, then the value of a currency is going to decline, right? Because there's more money chasing the same amount of goods, and therefore your money has less purchasing power than before. If the central bank decides to destroy money, right, to withdraw some currency in circulation, then there's going to be fewer dollars chasing the same amount of goods, and the purchasing power of everybody is going to increase. Yes. So you can understand, just hopefully based on that description, that central bank plays a role in the value of your money. Yes. And in doing so, with that power, they have the ability to manage what's called internal balance. Okay, so internal balance just means their objective to maximizing economic well-being within a country, and that's usually captured by three variables: full employment, price stability, and growth. And I already mentioned before, every country has different demands in their internal balance. U.S., for example, only really cares about two things: full employment at 4%, price level stability at 2%. Most developed countries follows these targets. Some countries really care about price stability, and they will have so-called inflation targets. South Korea, for example, has an inflation target. Most countries don't do that. Developed countries don't do that. Steady growth is another objective that they might want to pursue. As you know from mainland China, they have a GDP target for since the early 2000s. Okay, and that's kind of their objective: growth at any cost. I don't know if they really care about full employment or price stability, but as long as they're growing faster than they're printing money, it's fine. Okay. All right, so given that they have these internal objectives to satisfy, they also, because of international trade, have this external balance outlet to kind of influence their internal balance. So you can already see that if a country wants to grow through exports, they can easily manipulate their currency. I use manipulate in an agnostic way. It's not a bad thing. Okay? They can devalue their currency so that they are more competitive in international trade. But in doing so, they're going to create conflict with their trading partners, right? Because sometimes your trading partner doesn't want a weaker, stronger currency, right? Maybe they also want to grow, pursue a growth objective, maximizing their GDP growth, right? As well. Then they also be an exporter. Then you see the problem already, right? If everybody's a net exporter, then somebody has to be a net importer, right? So there's going to be obviously conflict among countries, and over the years, countries has different demands over time, and we've been switching between several different international monetary systems. So you can think about it, the history in basically three parts. You have the first part before World War I, where everybody was on the gold standard. So I'll talk about that. After World War I, we moved, so World War II, we moved on to what's called a quasi-pegged gold standard. Okay, so World War II, the U.S. became the reserve currency. Gold was U.S. dollars was backed by gold, and everybody else's currency was backed by U.S. dollars. Yeah, that's called the Bretton Woods system. So I'll talk about that. And you can already see the problem, right, based on that system, just intuitively. Post World War II, every country has been war-torn, basically. Everybody wants to grow through exports. Everybody wants to devalue their currency. So what do? They make their currency relative to the US dollar weak, right? So ultimately, US has to be a net importer. Yeah? So that was the consequence of this system. US ultimately became a net importer, and it became unsustainable. Okay, because basically you need to find as much gold. You have to find gold as fast as you grow. Okay, and if you run out of gold, then you have a redemption problem. It's like a bank run, right? If everybody redeems dollars for gold, you run out of gold. Yeah. Okay. Anyways, I'll talk about that. And then lastly, we have modern day. Most currencies are not backed by any commodity or assets, and everything is based on interest rates. Okay, and you'll see why. And naturally, if you take in corporate finance, you know that interest rates is basically linked to everything, all macro variables, and so forth. Okay. All right. So let's talk about international money. So usually, macro classes, banking classes talk a great deal about the role of money as a medium of exchange, unit of account, store value. So I'll talk briefly about that. Medium of exchange just means you can use money to buy things. Okay. Unit of account means you can compare value, okay, between goods, services, and store value just means that your purchasing power can remain relatively stable over time. You can buy an apple today and still buy an apple the next year, okay, something like that. All right, international money, system of national currencies. Yes, every country has the sole sovereign right to print their own currency, yes? And that's kind of a perk of being a nation, right? If you're a country, you want to actually you want to be able to use your own currency, print your own currency. Why? Because you want to be able to control the path of your economy, yes? You want to change interest rates. You want to be able to slow down, speed up, and ultimately build up credit, right? If you rely on other countries' currencies, then you're basically tying your economy with that country. So Hong Kong tying itself to US. There's pros, like you have stable currencies. You don't have day-to-day fluctuations, but at the end of the day, if the growth and development of Hong Kong differs from the US, then you have problems. You have conflict of interest, right? If Hong Kong is doing really poorly, interest rates go really, really high, we have to, you'll find out soon, okay? So if you haven't noticed, interest rates in Hong Kong move in the same pattern as US interest rates. And it's because of the peg, as I'll explain later. But anyways, relying on other countries' currencies is not a good idea, especially if the health of your economy differs from the currency you're borrowing on, okay? The dollarizing your own currency, okay? In other words, adopting someone else's currency as your own currency. All right, so given everybody wants to have their own money, there has to be some system in place to govern, so-called exchange, foreign exchange. And the first kind of rules came out of the gold standard. Okay, so that's the first thing I'm going to talk about. All right, gold standard. So what does it mean to have a gold standard? So let me describe to you what gold standard literally means. If you're a country, if you adopt the gold standard, what you do is you're going to fix some quantity of your own currency to a conversion rate with gold, okay? And you're going to maintain that conversion rate indefinitely. So let me say that again. Gold standard means that your country decided to exchange X amount of currency for some fixed quantity of gold. And your job as a central bank is to maintain that convertibility in unlimited quantities. Okay? The key point is unlimited conversion. So if someone brings $1 million US, so assuming the US was on the gold standard, someone brings $1 million US to the central bank, the conversion rate is 1 to 1, $1 to 1 ounce, then you should give me 1 million ounces of gold. Okay? Doesn't matter. You have to have it. If you don't have it, then game over. Okay? You can't, redemption problem. Your money loses credibility, right? Nobody wants to do trade with you anymore. Okay, so I guess the best way to understand how adopting a gold standard translates to inflation deflation is to use an example with a single good. So let's do that now. So suppose we are in Hong Kong and we adopt, and the currency board in Hong Kong adopts the gold standard, and it has a fixed conversion rate of 1 ounce of gold gives you 10 Hong Kong dollars, and vice versa. So for a single good, let's say 10 Hong Kong dollars per 1 apple. And we want to look at it, the price of apples in terms of, let me do it in fractions, so it's easier to read. 1 apple. And we want to convert it in terms of gold price. So let's assume the conversion rate is 1 ounce of gold divided by 10 Hong Kong dollars. Okay, so that's conversion rate we cannot change. Okay, gold standard means if we say this is the convertibility, we cannot change it. Then the price of apple in terms of gold is the following. Agree? So the price of 1 apple is 10 Hong Kong dollars, and we want to convert that price in terms of gold. We just multiply by 1 ounce divided by $10 of gold. And that will give us the price of apples in terms of gold. Agree? Now, under the gold standard, we can't change this conversion rate because we told all our trading partners, this is what I want to convert our local currency for gold. Okay, so if you want to buy Hong Kong apples, you have to bring gold to us and convert it to Hong Kong dollars. Once you have Hong Kong dollars, you can buy the apples and then import it back to your country. That's how the gold standard works. You got to bring gold to our country, convert it back, convert it to local Hong Kong dollars, use those Hong Kong dollars to buy domestic goods and services, and then ship those goods back to your country. So in this case, apples, right? So the UK, back in 1800s, I don't know, they wanted to buy porcelain from Hong Kong. They bring their gold to Hong Kong. They convert the gold. In this conversion rate, 1 ounce of gold per Hong Kong dollars. They get Hong Kong dollars. They use the Hong Kong dollars to buy porcelain goods. They load it on the ships, and they send it back home. Okay, that's how trade was conducted a long time ago. Okay. Now, the question here is, what happens when a country like the UK brings gold to Hong Kong due to the price levels in Hong Kong? So let's look at this equation. If the UK brings money, or gold to Hong Kong, there's going to be more gold chasing for the same quantity of apples once the gold arrives in the harbor, right? So with more gold in Hong Kong, then there's going to be inflation in terms of gold. Yes? So the price of apples must increase. Agree? So let me say that again. If the UK wants to buy apples from Hong Kong, they bring their gold into Hong Kong, and now within Hong Kong, there's more gold per goods for the same amount of goods and services. So goods and services, all else equal, the price of those goods and services have to increase. Yes? In terms of gold for now. Yes? So based on this equation, the right-hand side has to increase. You agree? More gold per goods and services. Goods and services have to be more expensive in terms of gold. Agree? Now, that's the right-hand side of the equation. The left-hand side, we cannot change this conversion ratio, right? Because under the gold standard, every country adopts a fixed exchange rate for some quantity of currency for some amount of gold. Let's just say 1 ounce of gold. And they have to hold that convertibility unlimited quantity forever. If we can't change the conversion ratio, then the only thing that can change in order for the equation to be identical on both sides is if our fiat currency, or paper money, also devalues, and therefore the price of apples in terms of Hong Kong dollars increases. Okay? Agree? So more gold brought into a country is going to create inflation in terms of gold, and because we can't change the conversion ratio to any extent, the inflation caused by gold has to be reflected in the devaluation of our domestic currency, Hong Kong dollars, right? So the price of apples must also increase in terms of Hong Kong dollars, and therefore imports of gold will cause inflation under the gold standard. Okay, that's the mechanism. So now you kind of get an idea, right? I talked about the price ratio before. So if prices are increasing, then something else is going to happen, right? Incentives are going to change. Import-export incentives will change. And this is going to lead us to what's called the price specie flow mechanism, in which the current accounts will stabilize over time. So I'll talk about that soon. But hopefully you understand now that in this case, imports of gold will cause inflation. Export of gold will cause what? Deflation, yes. Okay? And you should work through the logic yourself, right? Less gold chasing the same amount of goods, right? And that means the purchasing power of gold becomes stronger, and therefore prices should fall because we can't adjust the fixed peg, right, to gold. Okay. So the important thing to highlight is it is a fixed exchange rate between domestic currency and gold. Okay? And the natural consequence of this, right, if every country adopts the gold standard, in other words, fixed exchange rate between the same quantity of gold, then exchange rates should also be deterministic. Yeah? Agree? If every country fixes their exchange rate between gold for the same quantity of gold across every country, then the exchange rates between each pair of currencies within the gold standard system should also be fixed. Yes? Otherwise, there's arbitrage. I'll show you. I'll show you why there's arbitrage. Okay, so before I show you that, let me walk you through. Okay, so let me walk you through the why exchange rates are fixed first. So if you have two countries, you have one country that says 1 ounce of gold gives you X US dollars, for example, and you have another peg of 1 ounce of gold per Y, let's say British pounds. So I'm using currency codes here. So I hope I forgot to explain. GBP stands for pound sterling. Okay, USD is US dollars. All right. Then based on these two, based on X and Y conversion ratios, then you naturally must have an implied exchange rate, which is also fixed, USD per British pound equals to X over Y, X divided by Y. Okay, and this is fixed, right? So fixed conversion rate, gold standard means fixed conversion rate between local currencies with gold. If every country does this, then the conversion rate between every pair of currency must also be fixed. So in other words, gold standard gives you price stability. Yeah? No uncertainty. All right, so that's what we had under the international gold standard. And just by thinking about this, you can obviously see how this can be problematic under the gold standard. It's problematic because everybody has incentives to depeg, right? If I'm a country and I'm experiencing a war, for example, and I'm trying to raise money, one way to do that is to devalue my currency. In other words, depeg, change the peg, and I'll be able to sell more things and raise money for my war, right? So that's what happened, right? We had the Civil War, we had World War I, and this is World War II. Yeah, this is a giant mess, okay? And then we had Bretton Woods. So this is when we started to have cooperations with other countries. I mean, global countries all cooperated with each other. And they decided that the US dollar should be the sole currency to be pegged with gold, and every other currency was pegged to dollars. So again, still deterministic, still fixed exchange rate, but it's two layers of pegging, right? Dollars fixed to gold, everybody else fixed to US dollars. We still have fixed exchange rates. So let me write here, USD pegged to gold. So I use peg, meaning there's a fixed convertibility, okay? And all other currencies pegged to USD. That's the Bretton Woods system. And then you realize that this is unsustainable, especially because if you want to grow, if your country wants to be an exporter, you have to import a lot of US dollars. And that means US has to print a lot of money, okay? And they can't print more money than they can discover gold, right? And that becomes problematic. And so the choice is really between growth and collapse, okay? So you can't grow as fast as you find gold. And so ultimately we all went off the gold standard. So this is every FX rate is floating. That's what it means. Floating meaning it's determined based on supply and demand of the currency of real goods and services. It's no longer about backing of any sort of assets. All right, so let's talk a little bit more about the gold system, the implications. So under the international gold standard, the central bank's duties are quite simple. Their sole job is to maintain unlimited convertibility of their domestic currency for gold. Okay, and everybody does that. If all the players in the game, if they follow this rule, then we have very stable prices, and current accounts will stabilize over time, as long as you allow what's called the price specie flow mechanism to take its course. And I'll describe to you it very soon. But let me go over the other side effects of the gold standard. So naturally, because their sole dedication to this peg for every country, they have no monetary policy. So if your country is doing poorly, they can't change interest rates. They can't change money supply. If they do this, it naturally means they have to depeg, right? And that's a no-no under the international gold standard. So in other words, here, right? Limited function of lender of last resort, right? If you have a financial crisis, like the Great Depression, if the United States decided to maintain its gold convertibility, they wouldn't have been able to bail out or try to recover, they wouldn't have been able to do anything during the Great Depression, right? Anyways, Great Depression triggered depegging, everybody followed, and so you don't get this benefit of interest rates as a tool to control, to manage your internal balance, in other words. And I already said, fixed exchange rates, right? If we have under the gold standard. Okay, price specie flow mechanism. So how does an international gold standard maintain current account balance across countries that participate in the system? All right, so maybe I'll walk you through this example, and it'll be fairly clear what happens. So remember, the key thing to remember is this equation here, right? EP star OP. So the price ratio between countries is going to be our motivator to drive exports and imports. And this is where the gold price specie flow mechanism is able to achieve what it claims to achieve. So suppose a country suddenly has an unexpected current account surplus, okay? So we're assuming this country had a starting point of CA equals 0. So maybe I'll write that for simplicity. So I'm walking through an example of what characterizes the price specie flow mechanism. So suppose you have a country that has a current account balance of around 0, but it suddenly has a current account surplus. Perhaps it had a productivity shock. Their workers became smarter, and they get to produce more, okay? More for less. And therefore, they can have a current account surplus. And with this surplus, they can now accumulate gold, because everybody wants to buy goods from you, so they're bringing gold in. And this will raise prices, right? Do you agree? We learned from the example with apples and Hong Kong dollar peg. If you suddenly have a productivity shock in which domestic goods become cheaper because everyone's more productive, then more people want to buy from you, right? Because your goods are cheaper. But when people want to buy things from you under the gold standard, they have to bring gold to your country, and that's going to cause inflation, right? So prices are going to rise in the home country relative to gold. Agree? All right, so what happens next? What happens next is this domestic price level makes domestic goods costly for both domestic and foreign residences. So once gold arrives, that's going to cause inflation in terms of gold. That's also going to cause inflation in terms of the domestic currency, and therefore domestic price levels. So this P here is going to increase because of the inflow of gold. Agree? If domestic prices rises, then the relative price ratio is going to go the other direction now, right? So Q decreases because domestic goods more expensive because of the import of gold, and therefore other countries want to move away from our goods and services for other goods and services. Yeah? And therefore our current account is now going to move in the opposite direction back to 0. So do you kind of see where the price BC flow mechanism is occurring? So if we have a stable system, which everyone achieves a current account balance, and there is a sudden perturbation in the system in which one country becomes suddenly productive and they can sell things for cheap, then the price ratio tells us that they're going to eventually accumulate gold. But that accumulation of gold is going to translate to inflation, and that inflation is going to cause domestic price levels to rise. Over time, people are going to substitute away from domestic goods and services because it's expensive, and that's going to lead to an outflow of gold. Yes? And therefore, the current account decreases back to hopefully 0. Right? So that's the price BC flow mechanism. So any perturbation through any arbitrary perturbation of the price levels is going to change the flow of gold, but then changes in the price levels subsequently is going to lead to an opposite outflow of gold or inflow of gold. And ultimately, that's going to stabilize everything again. Okay? So let me write down that sequence of steps here, okay? So the example I gave you here, suppose you have an increase in the current account because of a productivity shock. It doesn't have to be productivity shock, it can be anything. Technology shock, something that makes a country produce goods cheaper and therefore dominates a specific goods market, okay? And they become the primary exporter for that good. So they have a current account surplus now, and that's going to lead to, right, because of the inflow of gold, that's going to lead to increase in P, right? So gold imports causes inflation. What's going to happen next is foreign goods are going to be cheaper, relatively cheaper, because domestic goods are more expensive because of the gold imports. And then countries are going to substitute away from us for our domestic, our foreign trading partners. So buy foreign countries' goods, services, which will outflow of gold, right? And decrease P, and therefore decrease CA. All right, so this price ratio is what allows this so-called price BC flow mechanism to achieve basically stable current account across all countries. And this requires that all countries maintain that pegged exchange rate with gold, pegged exchange convertibility with gold. If it doesn't, then you'll see, things just become chaotic. Okay. All right, comments, questions on my description of the price BC flow mechanism? The whole point of this is just to show you that the key mechanism, the price BC flow mechanism, is the price ratios between countries. So inflow of gold causes inflation, deflation. That changes price levels again, and that will lead to another change in price ratios, and that's going to lead to the opposite flow of gold, and then current account is back to its original level. That's the basic summary. And this requires that all countries maintain that gold convertibility with unlimited quantities of the domestic currency. All right, so that's the economic explanation of why, of how things stabilize. All right, but even in the financial markets, I can show you, as I promised earlier, that arbitrage should not be possible under this pegged exchange rate regime. So let's go through an example, shall we? Suppose the domestic currency is US dollars and the foreign currency is British pounds. And let's assume that GBP per ounce of gold is equal to 1. And USD per 1 ounce of gold is equal to 2. Based on this convertibility rates for these countries, the implied FX rate, let's call it EG, okay, for gold, is equal to this is in USD per GBP, okay. This is equal to 2. Agree? So you can do the fractions yourself. This is the price of British pounds in terms of USD. It must be 2 based on this shared convertibility quantity with gold. All right. So if there is a deviation away from this implied FX rate to some arbitrary quantity, I will show you that someone can make arbitrage profits. So suppose, for just simplicity's sake, I'm just going to assume that the market is irrational and quotes a market exchange rate equal to 3. Okay, that means GBP is more expensive than EG, right? The implied conversion rate. And I will show you someone can come in and make something from nothing. Okay, how do you do it? Here's one way. Step 1, let's borrow 2 US dollars, and let's use that 2 US dollars to redeem 1 GBP via EG. Do you know how that's done? We go to a bank, we borrow 2 US dollars, and we go to the central bank and say, hey, give me gold, right? Because they promise to maintain this conversion rate, unlimited quantities. So I take you 2 US dollars. Here's 2 US dollars, Federal Reserve, give me my ounce of gold. I take that 1 ounce of gold and I call up Bank of England, say, I have 1 ounce of gold. Can I get 1 British pound? Sure, that's their promise. So that's exactly what I get, right? I redeem 1 British pounds. All right, next step. I'm going to sell that 1 British pound for 3 US dollars via E. Right? Because that's what the market quotes. Some market maker decides to give me a rate of $3 per British pound. So I sell that guy 1 British pound, he gives me $3. So finally, I return 2 US dollar and I keep 1 USD risk-free. Done. I got something from nothing. Right? So can someone tell me, can this be exploited indefinitely? What I'm getting at is which step out of the 3 steps is going to converge EG to E? That's right, right? Because you are selling British pounds, and that's going to push E towards EG, right? So British pound is expensive, yeah? It's expensive at $3. But if I if I keep shorting it, if I keep selling it, it's going to decrease in value. And it's going to decrease to the point that I can no longer exploit this strategy. And that's when E equals EG. All right, so just based on the pegged exchange rates, assuming central banks peg maintain unlimited convertibility of gold, from the financial markets, there should be no arbitrage opportunity. Yes? So it's, in other words, if we allow speculation, speculation shouldn't be able to survive very long, right? So it's able to maintain itself, assuming this, right? Critical is assuming this. Okay, comments, questions on this example? So we'll do lots of this arbitrage stuff together. Okay, so this is just one of several arbitrage exercises we'll do in this class. All right. So I explained to you gold standard. It's a lot of incentives to kind of not play the game. Okay, in other words, depeg. If you want to grow your economy, you want to depeg, make your currency even weaker. So there's really no point to maintaining the peg. If you want to be an imperialist, you would also not play the game and just try to accumulate gold, as much gold as possible, which is what the UK did for many, many years. Okay. Yes, so it's the people who already have gold can play this game very well, and so the burden is obviously placed on those countries that have no gold whatsoever. All right, and obviously unsustainable. So the rules of the game that's mentioned here in this slide is a proposal by an economist that says rather than allow price specie flow mechanism to occur and slowly equilibrate, we can expedite the equilibrium by just simulating the effects of gold inflows, outflows. So what I mean is that if you expect gold inflows, for example, rather than wait for the gold to arrive, you simply create the inflation yourself. Okay, that's kind of the game. So if you're expecting outflow of gold, you would create deflation. So you have to change money supply. So by doing this, if every country does this, we don't actually have to move any gold whatsoever, right? Everything's just done on paper. It's like a game. But of course, that's bad incentives, right? People just lie or make stuff up, and yeah, it's not a good thing to adopt. Okay, especially if you don't have any gold. So in reality, what happens, as I explained, countries with a lot of gold already, they have every incentive to accumulate more gold. And if you want to boost your economy, you have every incentive to devalue your currency. So nobody really maintained. The gold standard didn't survive very long is what I'm saying. All right, so a picture of people breaking the rules of the game. So this is gold convertibility of US dollars from 1800s to 1971. This depegging is because of the Civil War. The U.S. had an internal civil war, and they wanted to raise some money for their war efforts, so they depegged. This is the Great Depression. U.S. tried to again support their economy by making their currency weaker, and they obviously depegged from the promised gold standard. And this is where we are. I think this is the Bretton Woods system. Yeah. Okay. All right. Next set of slides. Okay. Yeah. Great Depression, and another way to say you want to grow your economy at the expense of other countries' value of the currency. That's the beggar thy neighbor policy, right? You don't care whether or not their currencies, whether they want a strong currency or weak currency. You just want your currency to be weak so that you can satisfy your internal balance. And by satisfying that internal balance, you unload all your problems onto another country. And basically, every country just tries to unload their problems onto the next country, ultimately until one country has to basically absorb everything else, right? Absorb all the imports. Okay. All right. Britain. Okay. So after the wars, after no more political conflicts. We have a system in which every country decides to peg their currency to the US dollar. So they set fixed exchange rates with US dollars, and the US dollar was pegged to gold. Okay? And the main purpose of doing this is to facilitate war-torn countries like Germany to be able to, grow their economy through manufacturing and so forth, right? To some extent, you can see that today. Germany is like the dominant country in the EU. Okay. And of course, the problem with the Bretton Woods system, as I explained already, is that the American economy becomes the nth country, meaning they have to absorb every other country's exports because every country basically wanted to grow through exporting. That becomes problematic because it was direct conflict with their internal balance desires to also support their price inflation targets as well as their domestic employment issues. Okay, as you probably, if you took some history, 1970s was dominated by massive inflation and unemployment problems. Okay, and so they didn't want inflation. There's also what's called the confidence problem, because if you need to support everybody else, you need to print more money. And if you have more money growing faster than the discovery of gold, you have a redemption problem. You have a potential bank run. And so that's what's called the Triffin dilemma. So I'll leave that to you for further reading. So in other words, backing your currency for some commodity that doesn't have a stable growth rate, then you're going to run into growth versus redemption, Triffin dilemma problem, okay? Confidence problem. All right, I got to move fast. All right, so what we have today since 1973 is now we have basically a coexistence of mostly free-floating exchange rates, meaning nobody really backs their currency by any other commodity, but it has a coexistence with other exchange rate regimes. So you have Hong Kong with pegged exchange rates. You have Singapore with a managed exchange rate, so they allow the exchange rate to grow a certain path. China does the same thing. They have, I think, a moving band. Yes, so we have lots and lots of variations on this management of exchange rate patterns, and at the same time with free-floating exchange rates. And basically, it's everybody trying to, everybody just tries to satisfy their internal governance, and yes, so there's no really game that they play with each other, right? There's no gold standard, there's no pegging, global pegging or whatever. Everybody's on their own. You figure it out. All right. Yeah. Okay. Cool. Last slide. So the consequence of basically everybody does their own thing is you're going to have massive uncertainty in the FX markets. And one way to kind of look at uncertainty is look at gold prices over time. So whenever there's a crisis and confidence over the reserve currency, the US dollars, you typically flee to gold. Okay, so this is gold price over time from 1971 to 2008. Of course, I can extend it to the pandemic. You're going to see the same thing. So every time we see a loss in confidence in the US dollars, there's going to be a spike. So here we have oil shocks in which the price of oil exploded, and by naturally when price of oil explodes means the dollar is weakening. People flee from dollars to gold, right? So that's why gold price spikes. So all these here are oil shocks. And this one, everybody should know, right? This is the financial crisis. You have a systemic risk across the globe in the banking sector. Everybody flees to gold. Okay? Same thing happened during the pandemic. So the pattern is, this is a natural thing everyone accepts under our current regime, right? Because we have no real coordination on what exchange rate should be. There's no fixed exchange rates. Everybody has their own monetary policy desires and so forth. And we have wild fluctuations in exchange rates as a result. OK, so let me briefly summarize what we went over today, and we call it a day. All right. So summary of week 1. So what we did today is we talked about macroeconomic accounting. The reason why I talk about macroeconomic accounting is because FX rates has both a financial side and also a real side. So I talked about the real side first because exchange rates are used to convert not only financial assets but also goods and services, right, across multiple countries. And the key variable to keep in mind is what's called the current account. It's made of two parts, exports and imports. And it's part of the GMP equations. GMP equations, just like the GDP equation, but we're focused on national households and firms, right? We only care about the citizens and the national companies within the country that decides to keep the income within the country. So that's why we don't look at GDP. We look at something that's close to national income, namely GNP. When the current account is positive, it means that the country is both a net importer in a financial sense as well as a real sense, right? If you're positive current account, it means you're net exporting to other countries, meaning you're not consuming everything you produce. All the residuals are going elsewhere. So you're lending them, everyone else, goods and services, and you're accepting their currency so that you can spend some time in the future. So it's in effect a loan in terms of real goods and services. From the financial side, right, you know that I showed you the proof, right? Net savings minus investments, domestic investments, gives you savings abroad. And so the current account can be interpreted also as investments in other countries. The opposite when the current account is negative, right? Negative current account means you're a net borrower, you're borrowing money from abroad, or you're importing a lot of goods and services, right? All right, so I talked about the financial side. And the last thing I mentioned was the third interpretation of the current account. You can decompose the current account into two parts, trade volume and relative goods and services. The reason we look at this is because we want to look at the dynamics of current account eventually. So dynamics meaning how does changing the relative price change the current account? We touched that a little bit with the gold standard, right? And I talked about this already. And lastly, yes, this is the last thing I want to focus on. The key takeaway from the gold standard. If everyone fixed their exchange rates, you have naturally implied fixed exchange rates between all countries once everyone pegs gold to a certain quantity. And if that's the case, then whenever you have an import of gold, you get inflation. Whenever you have an export of gold, you get deflation. And with this mechanism in place, the price ratio will drive which direction the current account will go. Okay? And so that ultimately gives you the price specie flow mechanism. So whenever there is suppose we're in a stable current account situation in which all current accounts external balance are satisfied and everybody has their current account. If there's a sudden shock to the current account, there's a way to equilibrate, and that's through everyone fixing their gold convertibility and allowing price ratios to change back and forth, right? That's going to revert the gold flows, right, ultimately, over time. OK, so that's all I have for you today. So the last thing here is rules of the game. So that's simulating inflation, right, through changes in money supply. All right, so that's all I have for you today. Sorry, I went over 3 minutes. So next week, we will cover the asset approach of so we'll start building a financial model to price foreign exchanges next week. Okay. So if you have questions, I can answer them. I'll stay a few minutes after class. Otherwise, I'll see you next week.